The U.S. stock market experienced a dramatic plunge on March 10, 2025, with major indices recording significant losses. The Dow Jones Industrial Average plummeted by 890 points, marking a 2.1% drop. The S&P 500, a broader market index, witnessed an even steeper decline of 2.7%, making it the worst-performing day of the year so far. The tech-heavy Nasdaq Composite suffered the most substantial blow, plunging by 4%. This marked the largest single-day decline for the Nasdaq since September 2022. The severity of the downturn is further highlighted by the S&P 500's 8.6% drop from its 3-week high, representing the worst 6-day stretch since September 2022. This widespread sell-off pushed U.S. stocks to a 6-month low, reflecting a surge in investor anxiety and a flight from riskier assets. The suddenness and magnitude of the decline sent shockwaves through the financial world, raising concerns about the overall health of the U.S. economy and the potential for a deeper correction or even a recession. The market's downturn reflects a confluence of factors, including growing uncertainty surrounding global trade policies and rising fears of an economic slowdown. Investors are grappling with the potential impact of these factors on corporate profits and future economic growth. President Trump's recent comments on the economy have further fueled market uncertainty and contributed to the stock market's tumble. In a public address, the president acknowledged the possibility of a recession, characterizing the current economic climate as being in transition. This statement, coupled with his administration's ongoing trade disputes and tariff threats, has amplified fears among investors about the future direction of the economy. Adding to the anxiety are the president's comments suggesting a high tolerance for short-term economic pain resulting from tariffs. This stance has raised concerns that the trade war with China and other countries could escalate further, potentially disrupting global supply chains and impacting corporate earnings. The uncertainty surrounding tariffs has created a climate of apprehension in the market. Businesses are hesitant to make long-term investment decisions amidst the unpredictable trade landscape. This hesitation can translate into slower economic growth and potentially impact hiring and capital expenditures. The lack of clarity regarding the duration and ultimate impact of the tariffs has exacerbated market volatility. Investors are left to speculate about the potential consequences, leading to a surge in risk aversion and a flight to safer assets. The recent market plunge has had a particularly pronounced impact on the technology sector, with tech stocks leading the sell-off. The Nasdaq Composite, heavily weighted towards technology companies, entered correction territory, signaling a decline of more than 10% from its recent peak. The Magnificent Seven: Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla all experienced significant declines. Tesla in particular faced a brutal sell-off, plummeting by 15.4% and erasing all gains made since President Trump's re-election. The electric vehicle maker has been grappling with various challenges, including production delays, increased competition, and concerns about CEO Elon Musk's controversial behavior. Chip stocks, a crucial segment of the technology sector, were also hit hard. Marvell and ARM Holdings both experienced declines exceeding 7%, while the iShares Semiconductor ETF, which tracks the performance of semiconductor companies, fell by 4.6%. The downturn in the tech sector reflects growing concerns about the impact of slowing global growth and trade tensions on technology spending. Additionally, rising interest rates and concerns about valuations have also weighed on the sector's performance. Market sentiment has taken a decidedly negative turn in light of the recent stock market plunge. The VIX, often referred to as the fear gauge, surged to its highest level of 2025, indicating a surge in investor anxiety and a heightened perception of risk in the market. This rise in the VIX reflects the growing uncertainty surrounding the economic outlook and the potential for further market declines. Investors are increasingly seeking safety and reducing their exposure to riskier assets, as evidenced by the falling yield on the 10-year Treasury note, which dropped to 4.225%. The flight to safety is also apparent in the movement of other asset classes. Bitcoin, the world's largest cryptocurrency, plunged to its lowest level since November, trading around $79,300. The decline in Bitcoin can be partly attributed to disappointment over President Trump's recently announced Bitcoin strategic reserve proposal, which fell short of market expectations. Gold, traditionally considered a safe haven asset, also experienced a modest decline, falling by 0.6% to $2,900 per ounce. The decline in gold suggests that investors are not yet in full-fledged panic mode, but are nonetheless reducing their exposure to risk assets.